Hi, my name is Donna Woodruff with Capital Insight Partners, and I am the investment advisor to your company's 401k plan. And in light of current events and current market volatility, I thought it was important to send out a message about what our thoughts are about the markets and your 401k plan. I shared some information about a week ago with my plans regarding the coronavirus as compared to past health crises and how the market responded. So, if we just want to look at the top line there at the SARS epidemic, the April 2003 date is the end of the month where early incidents of the outbreak were reported. And 6 months later, that would be October of 2003, the S&P 500 performance was 14.59%. A year later, it was 20.76%. I think the important thing to realize is that unexpected shocks like this to the system create responses from the market that are just as unexpected and sudden. If we think back to 2008, it took the market about 18 months to reach the bottom of the market. And we have, assuming we're close to the bottom here, we've experienced our decline in less than a month. So I think we have to keep that in perspective as we're all together trying to work through this situation with the coronavirus, that the response from the market can be just as good on the upside and just as surprising and fantastic on the upside as it has been on the downside. It's also important to keep in mind that it is typical for the market to pull back, although these are unusual circumstances. I will give you that. It's typical for the market to have a pullback practically every single year. So what this graph shows us, we're just looking at the S&P 500, which is 100% in stocks, the top 500 companies in the country. So we're talking about your Amazon, your Apple, your Facebook, things like that are stocks that make up the S&P 500. The gray bars show you the return at the as of 12/31 of that year. The red circle with the negative number underneath it is the drawback during each individual calendar year. So, for example, in 2008, the market was down um, 38% as of 12/31. But at one point during the year, it had been down as much as negative 49%. And then even years that ended up positive, like last year, we were up, the S&P 500 had a 29% return. At one point during the year, it was down 7%. So it's not unusual for there to be these pullbacks in the market and for the market to recover to some degree, definitely by the end of the year. We see obviously the next 6 to 8 weeks as being very dicey. I mean, we expect there to be volatility, even though this week has been a good week for us. We all have seen where, as negative news comes out, it does impact the market. So, but hopefully by middle of third quarter, fourth quarter, there will be a consistent upswing in the market that we will see. And another way to look at it, these are the declines in the S&P 500 since World War II. And we're in the probably 20 to 40% range. The market was down about 32%. And that's only happened 8 times since the end of World War II. The average decline was about 27%. The length, the average amount of time that it took the market to decline was 12 months. And again, remember, this has happened to us within a month here. And the average recovery time in that case has been 15 months. But again, bearing in mind that we experienced this decline within a month, we expect the recovery time from this decline to be shorter as well. It's important during times like this to focus on your long-term goals for your 401k account. To think about the investments you have in there and that you're planning on working another 5, 10, 15, maybe even 20 years in some cases. But this graphic shows us is that if you were to invest $10,000 again in that S&P 500, so 100% in stocks, between January 3rd, 2000 and December 31st, 2019, If you left it invested, fully invested, now that would have been through 2008 as well, that 10,000 would have grown to $32,421 with an average return every single year between 2000 and 2019 of 6.06%. Now, if you missed 10 days during that almost 20-year window, 10 days, you would have reduced your return to 2.44%, or you would have your 10,000 would have grown to just over 16,000. It's important to remember that it's typically you can time when to get out of the market as the market is declining. The harder part is your reentry into the market and getting that right. Especially as we've seen this week, we were down 30% the end of last week on last Friday, and then Monday the market opened and it was increasing every day steadily. So it's important. I don't think people typically expected that to happen this week. So we have to keep that in mind, that reentry and timing that correctly can be very challenging. And as the statistics show us here, if we just weather the storm, stick with our long-term plan, that'll benefit our returns for the long term. And some people consider stopping contributing to their 401k plans when the market is going down. And I'm going to show you this graph that explains why that may not be the best option. What this shows us is for 5 months, if you put $300 into your 401k account every month for 5 months, so starting in January, you would have bought 10 shares because it was $30 a share. Now, if it stayed at $30 a share for February, March, April, May, you would have purchased a total of 50 shares, and you would have had 50 shares that at the end of May were worth $1,500. Instead, in this graphic, we see that the price per share went from $30 in January to $10 in February to $20 in March to $15 in April to $25 in May. Now, if you invested the same $300 each month, you would have purchased 87 shares, given all these different price points. And even if the value of your shares was $25 a share in May, your 87 shares would be worth $2,175. So there is an advantage to buying definitely as the market is going down, buying low, and holding your investment for a long time. Then you'll have more shares that recover with the market and more shares in general to satisfy your goals in retirement. But it's important, if you're able to continue investing in your 401k plan during the down markets as well. The other thing to think about is how you're invested. It's important to be diversified. Diversified accounts have weathered this market downturn better than markets that were 100% in equities. Now, the caveat to that is if you are young and you have a long time to be invested in the market, obviously if we look at the green blocks on this grid, you'll see that large cap stocks, that's the S&P 500 type stocks, they're never at the bottom, but they're also never at the top. They're closer to the top, but over the 14-year period shown here from 2005 to 2019, they had an average 9% rate of return every year. But there is, some volatility to experience with that. If we look in 2017 at the lavender block, we see emerging market equities, which had a return of just over 37%. 2018, it had a return of negative 14%. So it was the best performing asset class in 2017, worst in 2018, and then it wound up in the middle in 2019. Most people cannot handle this kind of shift in performance and up and down in their accounts. So what we recommend is a more diversified approach where you have a little bit of all these different colored blocks in your investments in your 401k plan. And if we look at the gray blocks that are attached by the dotted line across the middle of this grid, that's a 60% stock, 40% bond and cash. So that's a diversified, balanced portfolio. And it's never at the top, it's never at the bottom, and it averages about a 6% rate of return with less volatility than the higher stock equities. So we would argue that it's important for people to have a diversified approach in their 401k plan um, to be able to handle the downturns in the market like we've experienced in the past couple of weeks here. And if you need help figuring out the best option for you in your 401k plan, my contact information is going to be on the last slide, and you can certainly email me or call me if you want me to take a look at your individual account and discuss your goals and objectives and help you make an investment selection that helps you achieve those. And lastly, I just wanted to remind you that, investing in the market can be a bit of an emotional roller coaster at times. We've definitely gone through the panic. I think that was a couple weeks back as the market was going down. Maybe some people feel like we've reached despair. It remains to be seen if this is the end of the bear market. But many people in my industry would argue that as quickly as we've gone down, they would expect us to rebound quickly as well, that our recovery would be more like a V rather than a U. But it's important to stick to your long-term plans and goals and not make emotional decisions in your investments during times like these. And again, if I can be of help, please reach out to me. There's my direct dial number, 480-295-7114. My email address, donna@capitalinsightpartners.com. I'll be happy to review your account with you and help you make some recommendations as far as your investment selections. Thank you. Please be safe and stay healthy.